friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
Jen, what have you been up to today besides like trying to dodge the rain?
This is the first day in Charlotte that it is not raining. And it's not just like a little drizzle. We're talking pouring monsoon rain. I took a video yesterday. You can see the water like shooting off my roof. And it's been like that for 2 weeks in the middle of the summer when kids are home. They want to be playing outside. So it's had such a huge impact on everyone here psychologically that the sun is out today. And you would think that it was a national holiday. The number of people like walking by the house and out with their dogs. It's our liberation day in Charlotte from the rain. So I'm thrilled. We host a big annual picnic at our house every year for my college alumni association. So we have that tomorrow. And I was dreading it like happening in the rain, but it's going to be beautiful. People can swim. I'm so excited. So I'm great. I'm really, really happy.
Yay. And I know we also, it's funny, like, cause this was the week that all of our kids like got their teacher assignments. And I thought hilarious that all the parents were sort of messaging each other, like, who did you get? Who did your child get? Although Jen, you were just like, whatever, I don't even care.
Yeah, I don't care. It's funny. I'm so fortunate that I send my kids to private school where I like all of the teachers. I have we've never had I don't want to jinx it, knock on wood. We've never had a bad teacher assignment. The teachers are all wonderful. Anytime you say, oh, like, who'd your kid get? And they'll be like, oh, XYZ. We're like, oh, that person's awesome. Or like, I've heard great things about it. It's never like, oh my God, that one, so I don't know why we go through this whole rigmarole, but people get really upset if they like didn't get the teacher they wanted. I was getting some like very distraught texts from various parents. And it's always like, oh, I want our kids to be in the same class. But our school also does a really good job of not letting kids be in the same class with the same people, like the same homeroom or whatever you call it, every single year, because they want them to all be friends within the same grade. You're going to grow up with these people for the next however many years. So you need to meet everyone and not get super cliquey. They intervene very heavily in cliques.
Oh, interesting.
Which I wish had happened. Starting as like second grade girls, like you got to be on that. So,
yeah.
I wish we'd had that at our school together when we were growing up and you and I were isolated.
Well, it's funny. My middle, well, it's not even middle anymore. My eldest middle child, my second in the stream of four. My second quartile child. So she's starting kindergarten and she's met some of the friends of my oldest daughter who's going into second grade, or I should say she's met the sisters of some of the Catherine's friends. And so she was so sad. She like didn't get put in the class with these people. I'm like, you've had 2 play dates. Like you're going to be fine. You're going to make new friends. It's not like this is like a lifetime friend. Meanwhile, my oldest daughter, her best friend is not in her class. So she was like disappointed, but it's one of these things where I don't know, like she sort of like rolls with the punches a little more easily. So
good. So no, that's a really important skill. And it's funny, my kids last night, when we were having this conversation about their friends in their classes, they were like, Mommy, what years were you and Aunt Kristen in second grade? In the same class? And I was like, well, it's funny. We were in the same school system from 1st to 8th grade, but we weren't in the same class until 2nd grade. So we didn't know each other in 1st grade. And that was so mind boggling to them. Like, how were you in the same grade, but you didn't know each other? I was like, well, we went to bigger school and I don't know. And it just like happened. And
there's only like 100 kids.
Same classroom. Yeah, but I don't know. They were like, were you in the same classroom? And I was trying to remember. So we had 2nd grade together, 3rd grade together.
I think we had 5th grade. Mrs. Smith.
Mrs. Smith.
Yeah.
She was what an icon. Mrs.
I loved her.
I hope she's still alive. I hope she's listening. Well, God love you, Mrs. Smith. You were a goddess among women.
And then after that, I don't remember.
Middle school, I don't remember.
Middle school was just like trauma.
I was so traumatized. I've blocked out that entire section of my memory. So maybe
seriously. Yeah. But anyway, so speaking of nothing related to that, we're going to get into a whole bunch of things that are happening in the markets and some of the deals that are going on. And like there was this huge, I think maybe unserious deal that I have seen no precedent for something like this, where you have Perplexity, which is like an AI startup that has it has like NVIDIA backing it and SoftBank and, like Jeff Bezos, but they were valued at their latest round at $18 billion. They made a bid for Google Chrome which is obviously currently part of Alphabet, but that's details, for $34 billion. And you're like, wait a second, how does this work? And by the way, they did it as an all cash deal. So I want to go through some of the kind of like crazy shit that, I mean, again, like there's so many questions and there's a lot of things that are unanswered and people thinking that it's a PR stunt. But anyway, we want to talk a little bit about that. Jen had sent me this reel on like Gen Alpha slang, which has some kind of cool tie-ins to finance. So we're just gonna like chat about that.
It's a little bit fluffier. My children today than I feel like you've ever heard before.
This is probably true. And Jen has a very interesting theory about the Fed, something that is not like a mainstream view, but to me,
Jen's hot take day.
Jen's hot take on the Fed. And then if someone had messaged us about the fact that like in Europe, someone had compiled an entire list of like the people at JP Morgan who were first year analysts and was like trying to almost like sell it. Was it selling it to people or
no,
just give it out?
We'll talk about it. But okay. I want to talk about kind of the ethics of how to the ethics of networking in the modern age.
Yeah. Which is obviously very important. And then last couple of things. So there was an article that caught my attention because I'm going to do a video on this, but I began my career in 2007 in the CDO group at Morgan Stanley. Jen started at Lehman Brothers, which the two of us between the like CDO structuring group and Lehman Brothers were like at the heart of the 2008 financial crisis. And so we've talked a lot about how like that traumatized us. But one of the things that was interesting is at the time, I always was reading about how this canary in the coal mine was this increased use of something called PIK interest. And there was an article about how, or a Bloomberg article about how like that has actually ticked up to a 4-year high. That is a misleading article because it's literally a high from when they actually started to track this. So anyway, we're gonna get into sort of like what PIK is, why that's a potential issue. And then my favorite sort of Donald Trump story of the week was he told the CEO of Goldman Sachs to just be a DJ. So anyway, what should we start with, Jen?
Why don't we start with the Perplexity deal? Because I think AI plus M&A equals, have you seen that meme of the world's worst LinkedIn post where someone was like, the new formula in physics should be E equals MC squared plus AI. And everyone's like, stop, stop right now. But I do think that AI, like M&A, tech is probably the sexier thing than me being like hot take on the Fed, the yield curve.
All right. So as I mentioned in the beginning, so Perplexity made a $34 billion bid for Google Chrome. And again, some of the things that are insane about this is like, number one, this was an all cash deal. Number two, again, Google Chrome is not for sale. And like number three, like where the hell are they getting this money from? And so the first thing I want to just establish is like why this isn't typical at all in terms of M&A. So in most M&A deals, you have like a larger, more established company that buys a smaller one. And so as you're thinking about like, how are they buying it? Like, how are they financing it? It's either going to be cash, stock, or a mix of the two. And now typically when the buyer is using cash, they're financing that by going out into the public markets, or it could be private markets, it could be like a, private credit, and they're raising debt. Okay. Now, the thing about this is that nothing about this is typical because A, company is smaller. Like you have a smaller company, like half the size, trying to buy an asset that is twice as large. B, the company that they're buying, they're doing a cash deal. They don't have that cash on the balance sheet. They don't have the ability to finance that. They don't have the cash flows in any way, shape, or form to afford that. I saw somewhere that their revenue estimates are, somewhere between $50 to $150 million. And they're trying to buy something for $34 billion. Like you can't get a loan.
Service that debt with any portion of those cash flows.
That's like a fraction. And that's on the revenue side. We're not even talking about how much is trickled down into the actual like net income and then to cash flows. Like these are all, it's almost like I think of like a waterfall or like I don't know, like a inverted pyramid. Like you start with the revenues, then there's less and less and less and less. So, I mean, in terms of like how much cash flow they're kicking off, it's going to be like tiny. So I was trying to look up if there's like a precedent for anything like this. And there, as far as I could tell, is not. The one thing that comes almost like the closest to mind is in 2000, I think it was 2001, possibly 2002, during the dot-com era or the dot-com bubble era, you had AOL buy Time Warner. Now, what was different about this is, first of all, this was a couple things. So the two companies were roughly the same size by market cap. So like you look at the value of their equity, like the equity was roughly the same size, not again, a 2x differential where they were buying something twice as large. But AOL was generating like half the cash flows of Time Warner, which they were trying to buy. But because there was this like massive, again, just bubble, the stock of AOL was worth so much that they were able to buy Time Warner. But it's like when you're paying with stock and your stock is really inflated, it's like you're paying with monopoly money. So they did this deal and it has gone down as like one of the worst deals of all time. I think there was like $100 billion write down because, by the way, again, AOL just the valuation of that business like was not there. And again, like the Time Warner shareholders, I mean, they must have been like very upset that they were getting essentially stock in this company that ultimately went bust, or not bust, but it just like it did not have the value that they were assigning to it. And you can have things where there's like reverse mergers or reverse takeovers and like merger of equals. In some cases, the smaller company can be the buyer for like certain reasons, but there is nothing at all, like no precedent that again, I could find. And if you have seen something like this, please let me know. But I think what's so interesting about this is, first of all, even that $18 billion valuation, like a lot, I don't want to say the AI valuations are made up, but a traditional way that you tend to think about how much a company is worth is you sometimes look at what's called like the revenue multiple. Now, best case scenario, you have like price to earnings multiple. But again, a lot of these smaller companies, they don't have earnings, right? They don't have EBITDA. So the best thing you can look at is like, again, valuation relative to sales. And so if you look at an $18 billion valuation, even if we're being generous saying Perplexity is earning $150 million, that's like 120 times sales multiple. And just for context, NVIDIA's at 30 times and Google is 6 times. So this is, again, very rich. Now, with that said, I mean, that's not factoring in growth. And a huge reason why people are ultimately making these bets on things is they're like, AI is the future. It's going to like overtake everything. There's so much potential here. We don't exactly know how to monetize it. We don't know what the business model is. Similar to almost like that, the internet bubble era where it was like, we don't know exactly what the business model is. They figured it out. But again, like exactly how they're going to monetize all of that is still up in the air. So again, if you were like Alphabet and you're Google and you're sitting there, you're like, okay, this is obviously, it reminds me of in Succession, like not serious people. Like this seems a little bit unserious. Now, the question is now also where could Perplexity get the money? And it seems that there are some like unnamed venture capital backers. So again, it could be like your SoftBanks, whoever, and there is no information about how they would actually do this. Like, would they be, I assume it would have to be they were, giving equity because again, Google Chrome is a browser, right? And so it's not like it's really spitting off cash flows. Again, I'm not an expert in the business model, but the point is that this just seems insane. Now, last quick thing is like, is Google Chrome for sale? The answer is no. But what is going on is that back in August of 2024, the Justice Department had this like antitrust lawsuit against Google and essentially was maintaining that Google, the Chrome, there was like a monopoly where Apple was like paying billions to be the default search engine on Apple phones. And so now the next phase of like what happens, so it was, ruled to be a monopoly. Now they have to figure out how do you remedy that? So the courts are kind of like in that phase. Now, most analysts, it seems, think that they're just going to have to like have remedies where they have to, have limits on exclusivity deals and stuff, that it's probably not going to force a sale, but it's obviously possible. And so the Perplexity guys are saying like, hey, if you do decide that Google Chrome needs to be sold, like here's this bid, like we're willing and able to make an offer. So anyway, the whole thing though was just very different than some of the stuff that we've seen in the past. And so anyway, I wanted to kind of go through like why this is so strange.
Well, I think it's really interesting because you've used the phrase canary in the coal mine kind of twice already in our conversation. We're obviously talking about credit on one side that we haven't gotten to yet, but thinking about the precedent set by the AOL Time Warner transaction, which is constantly pointed to like as a classic example of a bubble bursting, right? To me, as someone who is not, I'm not an AI tech investor. I've missed out on whatever. It's just not my thing. I buy what I know and I don't know it, necessarily understand it. But could this be the canary in the coal mine of like, okay, maybe we've gone too far. We've got one company with, relatively low cash flows, suddenly making this giant balloon bid for another company that's a browser that what are its cash flow? Like, where is the money? And it's funny, we're doing an analysis of Michael Lewis's book, Moneyball. And there's so many finance themes in that. I'm so glad, Kristen, that you pushed me to do it. But one of the things there is, listen, the conventional thinking about baseball prospects back in the 70s and 80s and 90s was you looked at someone's potential and it was like, are they a natural athlete? What could they be? What's the dream platonic version of what that person could be? And Billy Beane came along and changed all that and said, let's look at the stats, right?
Yeah.
Let's look in obviously the finance analogy. Let's look at the cash flows, right? Well, what revenue is coming in and what's the history of cash flows? And can we then project those cash flows out into the future? And even if we just maintain those cash flows, let alone grow them, right? Like what's that's all worth from a statistics standpoint in baseball or from actually like a valuation standpoint in finance. And hearing about this, where it's like, okay, you've got one company that's this behemoth, but it also like as a standalone business begs the question of like, what is it actually worth? And you've got a tiny startup with very little cash flows that could be the next AI, but we don't know it is. So it's like a dream buying a dreamer. Like it to me, it makes me feel like the AI tech conversation has almost started to reach the point of absurdity. As someone who is not deeply immersed in this space, nor an expert on the tech, I do think that AI is here to stay. The question is, and we know it's like it might be a winner takes all, it might be a winner takes most, who knows?
Yeah.
But it's a very big gamble thinking about the order of magnitude of these mergers for these companies that haven't yet proven that they're going to be one of the winners.
Yep. I mean,
now,
again,
this might be part of the strategy to be the winner, right? To say, hey, in order to be the winner, you got to have a browser, and it's better to buy a browser than build one from scratch. I think
they tried. Yeah. And
yeah. I mean, full disclosure here, I know you use Google Chrome as your personal browser. I do not. I have to use it for this Riverside thing. And every time I do, I'm like,
do you use Safari? What do you use?
Yeah, I use Safari.
Interesting.
Well,
the take that the Financial Times had, I think it was Financial Times, I forget if it was Financial Times or Bloomberg, was that sort of similar to what you had said, which is like, this is just like a canary in the coal mine, that like shit has gotten insane. So they had a very similar view. They were like barbarians at the gate level drama here. I mean, and by the way, barbarians at the gate, it goes back to the heyday of like the LBO boom in like the 1980s. And that's another book that we got to do. So with that said, do you want to talk a little bit about just your theory with the Fed?
Yeah, I mean, it's not really a theory, but listen, I was venting to Kristen about this morning about another news organization whom we shall not name. And we are not news, we are not reporters, we are not journalists. Our job is so much easier because we just get to voice our opinions and we say, listen, we have this expertise, but we by no means are like trying to move the markets here or anything or dispel financial advice or anything like that. But I think like part of being a great journalist is also acknowledging when you got a call wrong and talking about why and what you've learned from that. And several months ago, we had this conversation where I was really concerned about yields in the long end of the curve immediately after Liberation Day and the announcement of the tariffs. And I really thought we were potentially staring down the prospects of failed auctions, failed long bond auctions, failed 10-year note auctions. These are the huge, chunky, longer maturity fundings that the US Treasury needs to do in order to keep our government running. And I was very scared. And we did see a big sell-off at the time, meaning a big jump in yields, higher in yield, lower in price in those instruments. Now, in the weeks that followed, as everything played out and we got our normal auctions again, everything went back to humming along, the financial press continued to write about the perils of the long end of the bond market. We have rallied in a straight line since then, and no one has changed their tune. No one said, hey, maybe I got it wrong when I was talking about how like the long bond was just a total POS and a dog with fleas. No one said boo, as far as I can tell. But it's been a one-way train towards lower yields in the long end. Now, there's a number of reasons for that. My theory is, quite frankly, we got ourselves in a bit of a cash trap where effectively everyone started to play for the Fed to ease, meaning cut rates in the front end of the curve. And what happens is when you say buy T-bills or very short dated instruments that benefit from the market repricing the likelihood that the Fed's going to cut, everything happens in one move. And then you're just stuck collecting these itty bitty, basically, how can I describe this? If the price of something goes from 50 cents to 100, right? And it's a very short duration instrument, you make an itty bitty amount of money, and then that's it. And then you're stuck in this low yielding thing, waiting for everything to happen. And you're back in this like, oh, what am I doing? Like, who's excited about 4%? Who's excited about 3%? Who's excited about 2%? Right. So you get in this cash trap, and there's this search for greater yield. Right. So then you go further out the curve so you can get that bigger impact from these mighty duration instruments.
Yep.
And that pulls yields down, right? That's why credit spreads have been so tight. Everyone's looking for yield.
Yep.
Because we may or may not have found ourselves back in the cash trap. Okay. The Fed has not actually moved. The Fed has not done anything. We have every politician out there talking about how you've got Scott Bessent saying that interest rates should be 150 to 175 basis points lower. We have fully priced in a 25 basis point cut of the Fed funds rate at the September meeting. I think it's September 17th. Probably should have looked up the date. So it's in almost exactly a month. I'm sorry if I'm wrong. I don't have the Fed calendar in front of me. That's fully priced in. And some people, it's actually more than priced in. So some people in the market are now buying lotto tickets on a 50 basis point cut, because if you will recall, a year ago when the Fed cut rates in September, they surprised the market with 50 basis points instead of doing the 25 that was priced in. So if you look at the front end of the market, we've got 3 full 25 basis point Fed cuts priced in between the September meeting and January of 2026. There's 4 meetings over that time period. So 75 basis points, 3 full cuts over 4 meetings. Okay. What happens when the Fed delivers that rate cut and we get some of this tariff data flowing through that, per the Goldman Sachs research article that you referenced, that led to the snarky comment about DJ DSOL or whatever?
Yeah.
A lot of economists and research experts estimate that we may not see the full impact of these tariffs flow through till October now. So it's Friday, August 15th. Just 2 days ago, or no, was it yesterday? I don't even know what day of the week it is, but we got the producer price index report, so the PPI number, and that rose at the highest rate that has risen in 3 years. It was a massive surprise. I think the market was pricing in a 0.2% increase, and we got a 0.9% increase. And these numbers are sound like, well, what does that matter? It matters a lot, because these are ultimately some of the inputs that go into the Fed's inflation calculations. And what happens when you have the Fed cutting in an inflationary environment? That is really, really bad for the long end of the yield curve. And the long end of the yield curve being those 10s, those bonds, those long-term interest rates that really impact where the government funds itself, but also all you people out there who are like, houses are too expensive. We really need to solve the housing crisis. We need lower mortgage rates. I just can't wait for the Fed to cut. What if we actually get the exact opposite of the intended effect, where the Fed cuts rates in the short end, but because they're cutting in an environment where inflation remains high, the yield curve steepens out, causing long end rates to sell off, because the yield curve itself is simply the market's expectations of interest rates in the future. Mm-hmm. And if you are in a low interest rate environment now where there's high inflation, the market will say, well, clearly in the future, rates are going to rise. Therefore, 10-year rates, 30-year rates out the curve need to be higher. So the doom and gloom for the long end of the curve that everyone was pounding the table about all spring that did not materialize, we had the opposite impact, which, by the way, we called here. That may now materialize as a kind of unintended consequence of the Fed finally delivering the policy that every politician has been clamoring for. That's my hot take. Yeah. I have no idea.
Well, yeah, I mean, look, it goes back to just like this main thing that I think people who haven't been listening to us, like who aren't really in the finance world, they don't understand that what the Fed controls is that short end of the curve. They basically control the overnight rate. And then obviously they have tools for some of the longer end stuff, but it's the market that is setting the terms. And it's that expectation, your point of future growth and future So like if you expect inflation to be high in the future, then that means that you expect the Fed will have to raise rates in the future. So the yield on those future bonds is going to go up. So your mortgage is typically priced relative to the 10-year, the 10-year bond. And I think most people, like, this is not something that they really focus on. But back to sort of the other thing we've been talking about with like the firing of the Bureau of Labor Statistics and like just putting potentially someone in, like saying you're going to fire Chairman Powell and put someone in who's maybe going to just do what the president wants and cut rates, whether or not that is what should happen or what they feel is the right move. You know, to your point, I do think that when you lose trust in the institute, like when you lose trust, it does mean that all of a sudden things can go kind of wonky. So like you cut rates and then future rates actually go up. So this all—
And to be very clear, there is data to support a rate cut on one side of the Fed's dual mandate. We just got this soft employment data. Now, we obviously have some questions around the collection of that data. What is the best way to do it? Why do we have these huge margins for error that have been now turned into a political issue? That is almost neither here nor there. The bottom line is I think just anecdotally, not to quote others, but like, I think we're in a vibe session and the vibes don't feel great in the job market right now. We are seeing more statistics supporting the idea that even the most highly educated coming out of universities these days are really struggling to get jobs in the job market. Talking to you, our followers, people are having a really hard time. Even people who have been very accomplished within the industry, who for whatever reason are on the beach or in between or looking for jobs. There's a lot of struggle out there right now that wasn't the tone when the Fed cut last year. I think that the tone feels a little bit more worse, just anecdotally, The tone feels a little bit worse, just anecdotally. And I think that is supportive of a cut in interest rates. What remains to be seen, and what Chairman Powell has been saying, is we still don't know what the inflation picture is going to look like because there's been so much policy uncertainty. And until we have incontrovertible evidence that inflation is not going to be so high that it offsets the softness in the labor market, we maybe should remain on hold and not act because potentially of those unintended consequences, whether it be a stagflationary environment where growth is stagnant, but inflation remains high, or you get the exact opposite of the policy that you enacted in terms of the market's reaction. The orthodoxy is that the market leads the Fed, right? The market says, okay, you guys are cutting. We get like, it's going to happen, right? The rally, everything gets priced in advance. And if the market is pricing in something that the Fed is like, no, that's not what we're going to do, they will communicate very loudly. This happened in, I think, 2022 when they began that first hiking cycle. They were like, they will leak stuff. They will publish a big article during their blackout. They will trust me. If the Fed is like, you guys are on the wrong track, they will let the market know. I don't think the Fed is sending any such signals right now. I think the market is pretty much aligned with what the likeliest path is from the Fed. But I do think there's this risk as the data comes in the next 30 days before that Fed meeting that we set up these stakes that could be very problematic for the average American for whom their concern is, the price of groceries, right? Which you and I both agree is like totally through the roof. I can't go to Whole Foods without spending more than $400 lately. I just restarted my Costco membership, but also their borrowing rates for their home. People are not buying houses right now because of interest rates. Some people say they are waiting for that cut to make that decision. If you're waiting, I think keep waiting. I just don't know that you get that rally in the long end without some kind of supplemental policy action to impact that part of the curve. That one cut in the front end of the curve may in fact have very unintended consequences for the long end. That's my take.
Well, yeah. And again, back to what we had talked about. We did that whole conversation about housing in general, that if you need to buy a house, like waiting for rates to go down also is not great, because if rates actually do go down, it also then pushes the price of the asset up. So like it's one of these things where it's like, at the end of the day, it's kind of like if you gotta buy a house, you gotta buy a house. I mean, we bought
buy a house. Yeah, don't wait. And then you say, right,
you can't time the market like to make it perfect.
The old saying in real estate is marry the house, date the rate, right? One of the amazing things about America is if you get a 30-year conventional loan and the rate moves 2 days after you close, you can refinance that loan with no penalty except for the closing costs associated with financing a new loan. I mean, it is truly a miraculous thing.
Yeah. So speaking of the softness potentially in the market, one of the things, like we had said before, like that canary in the coal mine, is the increase in what's called PIK interest. So before I get into like just why this is really potentially scary, or like why it's potentially a canary in the coal mine, I just want to explain what it is. I think of it almost like the buy now, pay later of interest rates, in the sense that, with traditional debt, someone lends you, call it $100, and let's say there's 10% that you need to pay in interest. So if you have traditional debt, someone gives you the $100, you have to pay 10% times 100 or $10 to them every single year while you have that debt outstanding. Now, what PIK interest does, it could be, by the way, the terms can vary. In some cases, it's PIK from the beginning. In some cases, there's what's called PIK toggle, where you can choose PIK or not PIK. But in the case of, let's say, that first year, you have to pay the $10, but you don't have the money. Like, there's softness in the sort of underlying business that you're running. So you decide, hey, I'm going to, instead of actually paying that $10 cash, I'm going to almost like add it to the tab. So you don't pay any cash, but the principal that you now owe goes from 100 to 110, right? That $10 gets added. And so then the next year you are paying interest on the 110. So you're actually now 10% times 110, you need to pay $11. And if you can't pay it, again, that's what gets added. And the value or the principal starts to balloon up. And so back in 2006, it was like this heyday of like leverage buyouts, and you had all these private equity firms that were buying companies and doing deals with just tremendous amounts of debt. And at the time, because there was just this huge demand, like people, what happens is like investors start to almost get, I don't want to say greedy, but they're looking for yields wherever they can get it. And so they say, we're willing to accept like less strict terms. Like they had what's called covenant light loans, where, you know, the rules were like were lax. And they also said, hey, you have the option that you can defer, right? You can use these PIK toggles. You can choose to pay in PIK interest over the term over the life of the loan. Whereas like, that's not necessarily a traditional feature. Those usually are, you start to see them more when, again, I keep saying investors get greedy, but it's like they're searching for that yield at any cost. And so there was an article that came out in Bloomberg. The headline was private credit's PIK usage nears 4-year high. But like I said, this is literally since they started tracking. And so private credit is a little different than sort of your traditional bond market, in the sense that this is where you have, and it's oftentimes with private equity firms, like they will do, for example, like a leverage buyout, and they will negotiate directly with certain lenders, but it's not the bank. So they're usually going to have to pay more, so a slightly higher interest rate than if they were to go to, say, like the syndicated bank market, like your JP Morgans, blah, blah, blah. They're going to pay a little bit more for almost like the convenience of only negotiating with one lender.
And to be clear, banks can be involved in these private credit deals, but they aren't then, those securities aren't then sold to the public markets, so that you're not renegotiating the terms of your loan with some granny in Idaho where this bond is trapped in her 401k.
Yeah. But also even like the leverage loan market, where it's still a loan, but it's a little bit different. But yes. So again, over the last 4 years, they've been tracking what percentage of companies are using PIK interest, and then what percentage of companies have what they call bad PIK. And so the difference is, like, in some cases you might use PIK interest because as you think about sort of the financing of the overall transaction, there's like the senior lenders, and then there's the almost like subordinated lenders. And sometimes the senior lenders have pretty strict limits about like how much money they'll allow you to pay the more junior guys in terms of cash. So there might be like, you can't, go above like 10% interest, cash interest, the more junior guys, but those more junior guys they're demanding 15% or something. So you might have like 10% cash, 5% PIK. So again, there's like a lot of different ways that this can all kind of get used.
Meaning PIK interest isn't necessarily always a sign of stress.
Yeah, exactly. But what is a sign of stress typically is when the borrower can choose to go the sort of PIK route. And so that's what they're calling bad PIK investments, where these companies are starting to get stressed. They don't want to use cash to make those interest payments. And so they are choosing to go the PIK route. And so those have ticked up from somewhere like 7.7% to almost 12%. And then of that, the bad PIK has gone from, like, looking at this graph, like 18% to call it 50%. So it's ticking up, which is showing potential stress in the companies that have been bought by these private equity firms. And so as someone who, is overly sensitive to this and has been waiting for the next shoe to drop since 2008, and it never has, like, we joke about this. Or I did, at least, it got so scarred that I'm always like, oh my God, the world is falling. But so that this may just be one more data point. I mean, there's so many good data and bad data points that are coming out. It's like valuations at all-time high, M&A activity gonna, hit like the second highest ever since 2001. Like, there's so many signs that things are good, but also part of that, I think, is like the fact that you have these valuations of businesses that are high, so people feel rich. So I don't know. Yeah, I'm going to shut up for a second.
No, I think it's really interesting for a layperson trying to parse out what the next 1 to 5 years of private capital investing look like, because just as everyone's saying M&A activity is at an all-time high. Well, what M&A activity, by the way? Because I think the stat now, we just talked about private equity secondaries. What is it? 1 in 5 exits out of a private equity investment are now into a continuation fund. So things can go into continuation funds when things are great. And we can say these are these flagship companies, the crown jewel in your portfolio. Why would you want to sell it when it's doing so well?
Yeah.
Or is it going into a continuation fund because there are no exits, because the returns haven't quite been what it is, because it's not necessarily hitting the marks that you will. So there's always a way to spin whatever the story is. There's been so much concern about systemic risk in the private credit markets being obfuscated because you don't have that efficient mark to market. You can mark these bonds at par every day if you want and just say, it feels like par. This bond identifies as par, but it may not be. But when you ask, well, okay, who's stepping away from the private credit market, right? If things are so bad, who's saying, you know what, I'm done? And the only one who's done so really publicly recently was GIC, Singapore's sovereign wealth fund. So more banks are getting into the space than ever. We have more regulations and more pushes to bring private capital investments to retail investors, to wealth, all these things. As more capital comes into the system, that should all else being equal be a good thing, right? Well, maybe. Yeah. Or maybe we're just now distributing this systemic risk instead of just amongst these big institutional investors, but now out to the public. I truly do not know. And I think you can craft that narrative in either direction based on the headlines that we see. So I think there needs to be so much more data. And I am so curious, right? Because like you said, it really boils down to the good pick versus the bad pick is who is electing this structure. Is it elected by the investor or is it elected by the borrower? And if it's elected by the borrower,
it's always the election of the borrower.
Sorry, to be clear, but it's the election of the borrower when the docs are signed, like these good picks. Because of the setup of the capital structure, because of all these different things. They weren't like, hey, let's set this up this way and make it more expensive for ourselves to fund this ourselves because things are so great. It's like, well, because of the structure of the junior senior, like whatever, we need to do it this way from the outset. And that's what's counted as the good pick, right? And the lenders creating those restrictions on how they can pay down those cash flows is what leads them to elect that kind of funding. It's not, oh shit, things are so bad, right?
Yeah.
So I call that lender elected, but it's lender dictated in my way of thinking about it because of the setup of how these lenders want to get paid versus the borrower elected, if you will, decision to switch from conventional interest payments to paid in kind.
So it's like the pick toggle versus the
what you're calling the toggle for someone who doesn't think in those terms, trying to explain a different way to frame it.
Yeah. Well, was it from the outset that was already like part of the financing picture, or was it something that was elected on behalf of the borrower? 100%. So anyway, that's something that I think is just an interesting canary in the coal mine. But switching gears a little bit, we wanted to talk a little bit about networking. And this actually kind of ties in. We are doing a LinkedIn Live in about an hour and a half, actually, at this point. On sort of like how to AI proof your career and how to network and how to essentially be a human. But this goes to the listserv, JP Morgan listserv conversation. So Jen, do you want to like get into what you heard and then sort of your thoughts on networking?
One of our followers sent us a Reddit thread where someone said, I've been interviewing for a bunch of different jobs within JP Morgan in London. And I've compiled a database of all of the analysts across the different groups that I've interviewed with of their emails. Let me know if anyone else wants it. I'm happy to share this database and share these emails so that you guys can all reach out to these people directly and ask for coffee chats. And somebody shared this with us, and my immediate reaction was like, were you raised by wolves? Like what? Who thinks this kind of behavior is okay? But then when I had a second to reflect, I can understand how somebody could think that this is like a good thing to do, right? Because if you aren't brought up in one of these institutions where networking is part and parcel of the gig, at Princeton, reunions start the moment you're accepted to Princeton. You become part of the alumni network. It's like, okay, not only are you getting your new 1,200, 1,500 best friends in your class, but you are now part of this bigger community and you think of yourself as part of this global thing. Like I said, we're doing our alumni picnic literally tomorrow, and it's with the new admits all the way through to people who are part of the old guard. And being part of that kind of system, you learn a certain type of networking about when it is and isn't appropriate to reach out to someone. People who make their email addresses available in an alumni directory and say, hey, reach out to me, like I'm definitely open to this kind of thing. And you have access to all of that at a lot of these institutions. There are so many people who are not coming through those institutions who are saying, well, I want that same level of access. How do I get it? And I can seeing something like, wow, this is awesome. This is making access available to someone who otherwise wouldn't know how to break in and wouldn't know how to strike up a conversation. We get, by the way, emails and LinkedIn reach outs every day saying, hey, like we'd love to have coffee, because we're public figures and we're talking about this stuff and we make ourselves available. Just because we don't have the bandwidth to have those conversations doesn't mean that I don't admire the effort to reach out. But we've made ourselves public in that way. These JP Morgan analysts did not kind of consent to have that information shared and to be spammed with emails from people who got it off a Reddit listserv. I also wonder what those emails say, because chances are that the whole point of networking is to build personal relationships with someone, right? So how are you going to build a personal relationship with a complete stranger that you found on an Excel spreadsheet that was floating around in a Reddit thread? That's a big challenge. If you are able to do that successfully, God love you, great. But chances are this poor JP Morgan analyst is now going to get 50 emails, all drafted by ChatGPT, that are like, hey, insert blank, whatever, you know, and have that cadence that's clearly written by AI or whatever. So I would caution you that this is not the gift that you think it is. And I think that the invasion of privacy, when someone hasn't chosen to make themselves available to this kind of opportunity, it's a very delicate thing. I'm curious to get your take, Kristen.
Yeah, no, so in general, the reason that getting someone's email is valuable is more about having the connection to somebody else, right? If I hear from somebody and they're like, I spoke to XYZ person who I know and trust, they gave me your email, my brain is like, okay, I'm gonna actually focus on this thing because it is verified through this whatever. So
there's this implicit consent that happens there, right?
Yeah.
Where like, it's so funny because this very morning, I got a text message from a friend from college who sent me a snapshot of the dating app Raya. And it was a picture of my friend. And he said, hey, how well do you know her? Would you be willing to make an introduction? Yeah. My friend has already consented to being contacted on this. I don't really know how Raya works. I've only ever heard about it in the context of Shep Rose on Southern Charm. But in theory, when you're on a dating app, you're consenting to be contacted. But he was still like, would you arrange a warm introduction? Because that's so much more powerful. And of course, that involves me then going to her and saying, hey, listen, I've got this friend. He's a great guy. Would you be open to talking to him? Or are you seeing someone? Like, is this app stale? Like, whatever. And just that extra layer, even though she's implicitly consented, and the language of consent gets so fraught with peril. So I really want to make it clear that what I mean here is like, it's the openness to starting the conversation versus the second you get like an unsolicited email, I do feel like everyone immediately has a wall up of like, I need to be protected
because we get spammed all the time.
Everything, exactly. Bad actors, people trying to get something from you. So the second there's that warm intro from a friend, there's a level of trust that comes in.
Yeah.
There's no trust when your information is floating around on an Excel spreadsheet and you get a random intro. And it's going to be, hey, this person that you didn't hire from a job who's now spamming the world with your email address.
Costly signals. Let me go back to that point that we had made last episode. There is something that is costly to you, to your friend, basically being the reference for a person. And so that's, I think, part of the reason why there is that implicit trust. There is no signal. So people just don't trust it. Now, I'm a little bit sympathetic to someone who really, really, really just wants to get a job.
Yes.
And they didn't have access to going to the Princetons. They didn't have access to like having, and so
I am too. I understand why people feel like this is a gift. Yeah. And
but I don't think it's going to land. And I think the main thing is like, there needs to be better ways for people to network. And I think this is where like headhunters and all that come in because, well,
this is what we're trying to ultimately do.
You need to actually have the human connection first as the sort of like entry point in, not a random dude who leaked this on the internet.
Yep. And if you are going through these interview processes and collecting these emails, just be careful.
Yeah.
I don't know that there's any necessarily like terrible blowback that's going to happen to this person or that could happen to this person. But like, also, it's funny. There was a great meme the other day, and it was like, if karmic debt is real, then there also needs to be like karmic credit and karmic credit default swaps. And like, this is my pillow talk with my husband laughing about memes like these. But just think about how you might be super open to being contacted by anybody, or you might think you're super open because you're in this networking mindset and you're trying to get a job and you're like, I'll take any and all conversations. But then once you get the job and you're working the 12-hour days and you're trying to juggle time with your family and your life and your health and your pets and whatever it might be, how would you feel if you were getting 50 emails a day that were unsolicited when you're not in that networking mindset? It doesn't predispose you to want to help those people. Mm-hmm. So I think this may be the most well-intentioned thing on both ends from the people who are honestly trying to break in, who don't have those networks and are desperate to build them. And I am so sympathetic and I completely understand. And I want there to be better ways. And that is something we feel deeply passionately about. I just don't think this is the better way.
Yeah. It's just the difference is you have to have the person whose email you are sharing say that it's okay to share it and be open to being contacted. Honestly, like if someone were to email someone at a bank and say this, I think it might actually create a complete opposite impression that you're looking for. So
you might be dismissed with prejudice from consideration.
Yeah.
Okay. And last but not least, speaking of how younger people are talking and behaving, a little levity here. My son came home from tennis camp and was talking about his tennis partner. And he was like, oh, he was totally selling. And we were trying to figure out what this word was. And we were like, what are you saying? He was sailing. He was what? And he was like, no, he was selling. Like, dude, you totally sold it. And I was like, is this Gen Alpha slang? And sure enough, somebody sent us a meme that confirmed that this is in fact like, oh, like that selling is lame, or like that sold means it's lame. And my husband and I got into like a quasi-serious conversation about how Gen Alpha is quite literally a product of the quantitative easing environment, where you are never supposed to sell you're never supposed to sell stocks. You're never supposed to sell an asset. You're supposed to just buy everything and hold it forever and like never sell the market. And like that this actually got ingrained into the language of the next generation coming up, that like selling is a bad thing. And it's funny because we joke about trading jargon. You always said,
I'm a buyer.
When you're like a douchey Wall Street person, you're like, oh, I'm a seller of that restaurant. It sucks, right?
Or I'm a buyer. I say I'm a buyer because I'm like, but it's just because we're around all these financy people and they use those terms. Yeah,
exactly. So you hear it all the time. People use it, but people will even say that in a self-deprecating way, like in a wink, wink. I know this is such a douchey thing to say, to act like a trader in the public sphere or whatever. Like,
I don't. I will say I'm a buyer and not at all think that I am douchey. But it's wild that it is now, like 7 and 9-year-olds who are using this term.
I do think, and I could be wrong, and maybe there's like some, I don't know, Disney Channel or TikTok or YouTube star or whatever, but I do think that actually this is a case of the English language being shaped by the finance of our times.
Well, I will add, it's funny because one of my daughters would always say, for real life. And like, so, it would be asking a question, be like, for real. And she always says, for real life. And I was like, where the heck did she get this? Or like, oh, biscuits. And it comes from Bluey. Like so Bluey definitely is shaping how our kids talk. The sad thing though, and this is like related to just we're obviously millennials, which by the way, we're like Gen Y, and that just never caught
until
on.
They found a name for us.
Until they found something better. My poor son is going to be Gen Beta. Apparently, like it starts in like 20.
A better name.
They better find a better name. They're like Gen Alpha, A+. Like that is an awesome name.
Literally.
Gen Beta, are you kidding me? Like we got to find a better name for these poor little kids. Like
yeah, hopefully it'll be because of some massive positive development and not like some catastrophe that they're then named after. It is funny too within millennials how there are so many subsets of millennials, right? It's like, are you an Oregon Trail millennial? Are you a
what's that?
millennial?
I only know elder millennial thanks to our friend Schlesinger.
Elder millennial. Yeah. There's so many. Did you ever play the game Oregon Trail? We played it in.
Yes, we played it in 5th grade with Miss Smith. Yes, I did.
Yeah, exactly. So like there's all these different subsets of millennials because like I mean, who wouldn't want to be a millennial? We're clearly the best generation, so like everyone wants to be a part of it. So people are like, oh no, I'm a Napster millennial or I'm an elder millennial or whatever it is.
That's funny. I've never heard those terms. I've only ever heard elder millennial.
Oh, there's so many. No, there's so many like little subsets or whatever. Or I guess there was an attempt to rebrand the millennials as the Oregon Trail generation maybe. And like it just didn't quite have enough.
My feelings. No.
Enough support.
Yeah.
All right, anyway. So coming up on the docket, fun stuff that we're doing. We will be doing more live events. We are hoping to make this LinkedIn Live series that we're doing, How to AI Proof Your Career, a monthly recurring series. We already have 2 more amazing guests lined up for that. It's free.
Well, share who the guest is today.
Hour. Yeah, today's guest, again, this will air after that, is Frank Van Buren, who was a guest on our podcast, one of our most popular podcast guests of all time. He's a former Black Hawk helicopter pilot who then went on to have a 30-year career on Wall Street. He's just such an inspiration, such a wonderful storyteller, and an all-around amazing guy. So we figured if there's anyone who is like AI proofed for the rest of his life is probably Frank, but he's amazing because he also, having such deep experience working within these institutions, has seen all of the initiatives with respect to AI and technology development and how they are being implemented within the investment banks. So we have that insider information that you won't get anywhere else because no one's going to tell you the truth. And then we've got a couple other people lined up for the coming months. So I think we'll try to run this series through the end of the year. We're working really hard on growing on LinkedIn and on YouTube. So if you don't already, please follow us there. I think we're going to also add in potentially a YouTube live series before the end of the year. So if there's any topics you guys would like us to do a similar series to the AI proof that we're doing on LinkedIn, we're certainly open to suggestions. We have a number of ideas, but we always know what you got. We always want to know what you guys are more eager to hear. We've got some big book and TV reviews coming up since we're finishing up with not Succession, goodness me, although we do need to finish.
We need to do that one too.
Succession, but we'll be finishing up with Industry and we'll be all caught up and we simply won't have a season 4 to review. So we've got Moneyball coming up by Michael Lewis. We've got a whole bunch of other classic Wall Street and finance books and movies that we'll be reviewing. We may try to tackle Billions, but that feels like such a heavy.
I think we need to get the sales and trading course out first, and then we'll do Billions.
But also on the TV front, this is just a personal note. With the reboot of Buffy the Vampire Slayer, all of you who have not watched Buffy the Vampire Slayer from start to finish, please watch that show. I would argue it is the best show of all time. We have joked since episode 1, minute 1, that if we could figure out a finance of Buffy, we would do it because it's so good. But also simultaneously, you know what else is having a moment that is from our childhood is Dawson's Creek.
Yeah.
Because there is a new, I have to call them Pacey and Joey. There is a new Joshua Jackson, Katie Holmes movie that's apparently being filmed in New York. And people are filming the footage of them interacting and being like, no man will ever look at a woman the way that Joshua Jackson is looking at Katie Holmes, even if they are acting. We all grew up with this as like the best romance of all time. And I just, so if you haven't done like a Dawson's Creek watch or a rewatch, it's nowhere near as good as Buffy. Like it was a very specific moment in time. It hasn't held up that well. It's like the 90s angst or whatever. And the crying Dawson meme, which was a big one. But yeah, so we'll be doing all of like the hard hitting finance TV, but man, if you guys want some entertainment, go back and watch those 90s and early 2000s show. They just don't make TV like that anymore.
No. So anyway, with that, I think we covered everything. And so if you are enjoying the show, please leave us a written 5-star review on whatever your podcast platform of choice is. It really helps us grow. And thank you guys so much. And we will see you next week.
Bye.